This is a panel which is going to be hybrid. We have Gabriel, who is detained in Paris by issues with Eurostar, and Isabella is not able to travel. But let me go straight to the substance because we're late and we want to go to coffee eventually after this. I want to start with Doha Mekki. Doha, you are the sole agency regulator in this panel, which is a panel of economists. So in some sense, you're also the Christian amongst lions. But you've heard the previous panel, and I know you're absolutely the forefront of this, certainly this pursuit of an enlarged and more active approach to enforcement. And you've had some recent successes in the US, and so coming to the back of the discussion we just had with judges, there was a sense in the US that you were going to be stopped by the courts in your enforcement effort. And yet, there are signs that this is not really yet happening, or certainly it has changed. You've had a major success with JetBlue's Spirit. Talk to us a little bit about that before we move to the rest of the panel.
For sure. Thank you so much for having me, Christina. I think this has been a fascinating conference so far, and I really liked the discussion among European judges that we just heard. So in terms of some of the I would characterize them as maybe hopes and wishes that the courts would stop the agency's current approach to antitrust enforcement. I think that was just that, maybe some hopes and wishes. And I think the conversation that we are having internally, the approach that we are taking with our staff, and in the way that we present cases causes us to go back to first principles. So on the subject of the law, it was very interesting hearing Sir Marcus talk about textualism and propositivism. I think in our efforts to understand antitrust law, which is not coextensive with IO economics, we have understood a broader set of values that are, that basically inform the antitrust laws as they were written in the United States, and more than 100 years of jurisprudence that recognize that while the singular goal of the antitrust laws is competition, there are second-order values and benefits that are very much worth protecting. And so we try to be mindful of the difference between goals and standards. We think about the values embedded in the law, and we think about some of the more radical changes that we saw in the 1970s and 1980s in the United States to try to reimagine what antitrust law was about. And I think we are on record as having some concerns about the radical departure that took place during that time period. So that's the first prong, that's understanding the law. Understanding the facts is incredibly important to us too. When we think about mergers, when we think about business conduct, we are focused on understanding the facts on the ground and the facts as they are. I think that sometimes when the agencies, and I'll talk specifically about the Justice Department, have had challenges in court, it has been because we've tried to fit facts to models. And sometimes those models are not well suited for the modern economy, right? Is every vertical case about input or customer foreclosure or needing to enter at multiple levels of a value chain? Of course not. Of course not. Vertical cases are often about power and how companies may exercise that power. And so I think we are concerned that when we reduce facts to models that are not well suited, that what we're really doing is applying heuristics. And it is very important that the law be preserved and that we apply facts appropriately to the law. And so that brings me to the cases that we've brought to courts. Interestingly, whether we've won or lost cases has tended to be on the facts. We have not seen judges outright reject theories of harm. The theories have actually been solid, even in cases like United Health Group Change, where for the first time we sought to block a merger in part on the basis of access to competitively sensitive information. I think our judge understood that that's a viable theory. But in terms of our factual presentation, we've tried to bring it down to the level of the person. In our most successful cases, we have talked about what power really looks like. And I think the staff has done a great job of convincing courts that there are some mergers, there's some conduct where maybe we should not trust corporations with all of that power, because if you allow that power to accrue via mergers, they may exercise it in ways that maybe we can predict today, but ultimately may not be able to predict down the line. And so in Penguin Random House Simon & Schuster, which was a merger between book publishers, we did not spend a lot of time focused on the output effects and the, strictly speaking, number of books that might be published in the future, but about the incentives to create works that are important in the first instance. It was a buy-side theory of harm, which we spent a lot of time working on and trying to understand in the agencies for many years before launching that merger challenge. In our Northeast Alliance case, which was a de facto merger, the court certainly found price effects when American Airlines and JetBlue attempted to form a joint venture, but the court gave a lot of time to understanding the non-price effects of that kind of combination. And most recently in JetBlue Spirit, which we're incredibly proud of, we had a judge who did not have a hard time understanding the goal of the antitrust laws and said, and I quote, that the proposed acquisition does violence to the core principle of antitrust law. And he understood and referenced back to our efforts to try a case that is focused around the cost-conscious consumer, right? The person who would not be able to take a vacation but for Spirit's low fares, the college student who wouldn't be able to get home but for Spirit's low fares. And he also understood that Spirit's impact on the market can be felt regardless of whether you fly Spirit or not. And so I think the question that was teed up for me is, have the courts changed their approach? Are they buying our ideas or not? I think it's more important to note that the agencies themselves have changed. And I think the way we are talking about power, about private coercive power, which is at the core of a lot of our enforcement, has changed. And I think regardless of whether judges have priors, intellectual priors or not, we have found incredibly hardworking generalist judges who listen patiently and weigh the evidence. And it's really our belief at the Justice Department that it's incumbent on us to present the facts in the most compelling way we can.
This is wonderful, and I love, again, the emphasis on power and the framing of cases in this particular form, which is, again, the novelty that I want people to take away from this conference. We have moved, and the US agencies are particularly at the forefront of this. There can be some reluctance to recognize this is what we're doing, but it isn't so. This is the current reality. I want to move to an amazing collection of economists whose work in various ways essentially has relevance to this question of power and concentration. In various ways, these economists have contributed in the last few years and even more recently to the discussion about what are the dysfunctions that power inflicts on the economy. It's just not an abstract concept. It is something which has manifestations in the real world, which then Doha and the agencies seek to recognize and deal with. I want to welcome first Isabella Weber, who is unfortunately unable to join us in person, and it would have been great to have you here, Isabella. I want to jump straight in and give you the opportunity to explain to the audience why your views on what drives inflation and the connection you have made with pricing power have been controversial, but on the other hand, also important to the discussion about what is happening out there and what we see in the real world. What do consumers have to face and what is driving it? Please go ahead.
Good morning, Christina. Thanks so much for having me, and I'm really sorry I couldn't be there in person due to personal circumstances. Thank you so much. So the puzzle is, of course, that we had incredibly high levels of corporate concentration at a time when prices were pretty stable, almost too stable, right? So the question is, how can we have been in a world of enormous corporate power and concentration with stable prices, and then this same kind of corporate structure has given rise to the kind of inflation that we have observed in the last years. I have been trying to approach this question in two ways. On the one hand, we have been doing input-output modeling, where we have tried to do some impulse propagation tracing in a network setting. And on the other hand, I have been studying earnings calls to try to understand how firms actually think about their own pricing behavior. And I'm thinking about the inflation process basically as a three-stage process. So the first stage is an impulse stage coming out of this situation of price stability, where systemically important firms and sectors, in sectors like energy, food, essential raw materials, transportation, ended up experiencing massive price spikes. Now, these are by and large sectors that are more or less like commodity type sectors, right? So I'm not saying that in these sectors, firms are setting prices. These firms do have market power. If you look, for example, at grain trade, you have 4 companies that basically are the grain market, right? They control more than 70% of the grain market. But nevertheless, I'm not saying they are setting prices, but due to the massive shocks, shortages, fear of shortages, chaos in these markets, we have seen price and profit explosions that resulted in often unprecedented profits on the parts of, for example, those grain traders, for example, the fossil fuel companies, which of course raises the question of whether we can entrust the resilience of these critical sectors to firms that have learned that they have incredibly benefited from a lack of resilience, from a lack of supply chain stabilities. Now, these price and profit explosions in these critical sectors have presented themselves as cost shocks to all firms that are using these upstream goods as inputs. Now, in these more downstream sectors, we do have a lot of firms that have price setting power. Now, as these cost shocks hit whole sectors, these cost shocks basically functioned as a kind of coordinating mechanism where everybody in the sector knew, okay, the input prices are shooting up. This is the moment to increase prices in ways to protect our profit margins. If a firm protects its profit margin in response to a cost shock, that means, as a matter of accounting, an increase in unit profits. So this is, in some sense, a form of tacit collusion where these firms didn't even need to talk to one another to say, I am going to raise prices, are you also going to raise prices? But as a matter of the logic of pricing to protect margins, combined with these cost shocks, this kind of coordination came about. On the side of consumers, these price increases were perceived as often more acceptable than the firms had even expected consumers to think these prices would be perceived, which has been labeled excuseflation, because consumers have been hearing on the news day in, day out that there are these shocks, that there is this chaos, that there are all these supply chain issues, that there are shortages and so on. So they became more accepting in absorbing these kind of price increases than they would have been in normal times. So from this first stage, you get this impulse stage in the critical sectors, you get a profit and price explosion. At the second stage, you basically get a pass-on dynamic that nevertheless increases profits for these firms. At a third stage, eventually, workers react as from stage 1 and 2, real wages collapse. So eventually, labor will fight back, and we have seen more of that in a hotter labor market in the US than we have seen in Europe. But in any case, eventually, there's kind of a catch-up dynamic on the wage side. But that is an outcome of stage 1 and stage 2, rather than the origin of this kind of inflation process. Now, some economists have tried to test this hypothesis by simply looking at the relationship between profit margins and prices which I think does not get at the core of the matter, because you have some sectors in which you have indeed margin explosions, and you have the majority of sectors and the majority of firms where profit margin protection is enough to result in unit profit increases and to turn a local shock in a systemically important sector into generalized kind of inflation.
So briefly, your work has been hugely controversial, and this is part of what Tommaso Valletti was referring earlier to, in some sense, the tribal clique of economists who are pretty reluctant to accept ideas that are not viewed as entirely in the orthodoxy. But your message is not that inflation was caused by profit-taking, but there was a contribution to inflation by profit-taking through mechanisms such as tacit collusion, perhaps. But that is also linked to the power of firms in markets, in a nutshell.
Yes, and I mean, it's a kind of interesting, because I think it went from, oh, this is super controversial, to we have known it all along. So I think we are kind of like almost in the we have known it all along type of stage of this debate. I mean, the IMF has been saying that profits have played a major role in the inflation process. The ECB came out with studies that have made basically exactly the same points that I've been making. The OECD came out with studies that have been making basically the same points that I have been making early on. So I think like kind of this at this point is in some sense part of the established interpretation of this inflation. I think people who now in 2024 say that this inflation has been triggered by wage increases, I really want to see the data for that. So I think this does raise questions about how, as economists, we deal with different forms of data in real time, right? Because we have very limited data on these kind of questions. And one thing that I have heard so much is, oh, you haven't shown me the data. Well, I've gone through hundreds of earnings calls. Firms are saying it, right? They're on record saying there have been cost shocks, and the rational thing to do is to increase prices to protect margins. Financial markets are saying we want firms to protect margins because that's what we want to see in a firm's performance, right? So we do have an enormous web of data, as a matter of fact, but this data is very messy, very difficult to analyze in real time with standard kind of methods. So I think in this world of overlapping emergencies that we are living in, where we will be confronted with unprecedented situations, kind of by definition of what this moment is about, a greater open-mindedness in considering all sorts of evidence that is forthcoming and having an open, unprejudiced conversation that does not brand those who have a diverging view as somehow truly stupid or worse, but that takes this kind of evidence serious. I think it's really a matter of survival almost at this point if we want our economies to gain the kind of resilience that we need in the context of climate change, geopolitical meltdowns, and all the shocks that seem to be in the pipeline.
Thank you. Could I have Gabriel on screen if we have him too? Gabriel Zucman, I saw him. Otherwise, I can shift to Gabriel. Excellent. Too bad, again, you couldn't make it this morning because of the Eurostar issue. Let's go straight to the issue. Your work is renowned. You've done work with Professor Piketty. You've just published a global taxation report, which is going to another important dimension of the question of profit-taking and ultimately the way in which it translates into inequality and problematic outcomes. Talk to us briefly about the gist of your latest work and why do you link that with market power and how we worry about that. Thank you.
Thank you so much, Christina. It's such a pleasure and privilege to be part of this conference. So I'll try to be brief and to the point. It's impossible, in my view, to talk about market power, about corporate regulation without talking about the T word. And the T word is tax, 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 tax. Why? Because one of the most striking developments in the regulation of corporations over the last decades has been the dramatic decline in effective corporate tax rates. So look, for instance, at the US. In the 1950s, the effective corporate tax rate in the US, effective tax rate, not just the statutory rate, but the effective rate was about 50%. Okay, so that means that out of any dollar of profit, half of that went straight to the IRS in corporate tax. Today, this is down to about 20%. Effective tax rates for US companies globally, when you add up all the taxes that they pay throughout the world, is down to about 20%. A lot of that decline from 50 to 20% reflects rising tax evasion. Some of that decline, to be fair, reflects democratic choices, but a lot reflects tax evasion. Look at profit shifting by multinational companies. Each year, according to the estimates that we have in the Global Tax Evasion Report 2024 that we being the EU Tax Observatory, just released last year, for multinationals, about 1,000 billion euros in profits are shifted each year to tax havens. So these are profits that are made in countries like France or India or the US, and that end up being booked and taxed at very low rates in places like Ireland or Luxembourg and so on. And I'm not using those countries as examples as a pure coincidence, but about half of this shifting of profits to tax havens actually involves European tax havens, like those that I mentioned. So what are we talking about concretely? Just to be clear and to be sure that everybody understands, let me take one very concrete example. In 2003, just a few weeks before being listed as a public company in New York, Google sold part of its search and advertisement technology to its own subsidiary in Bermuda. Between 2003 and 2019, when this tax evasion ended, Google and then Alphabet booked several hundred billions, and that's with a B, several hundred billions in revenue in Bermuda, where the corporate tax rate is a relatively modest tax rate of 0%. And look, it's a striking example. It's just one company in just one sector, but this problem of tax evasion to tax havens is an across-the-board phenomenon. It's not just in tech. It's not just US companies. It's global, it's across countries, and it's across sectors. Now, even though it's difficult to quantify, it's likely that this tax evasion has played a significant role in the rise of market power and market concentration. Everybody understands that there are some fixed costs at creating these structures. It's difficult if you're a small business to pretend that you have a lot of customers in the British Virgin Islands or in Bermuda, or to create structures that will look legitimate. It's easier to do so if you're a big multinational companies, especially if you can hire the best lawyers to create the most aggressive schemes with the highest probability of avoiding enforcement. What I want to say is that this tax evasion, just like the rise of market power more broadly, reflects a deep failure of enforcement. Of course, when you ask companies about this tax evasion, they say, no, it's not tax evasion. Not at all. It's legal tax planning. And this is all in compliance and in accordance with all the laws and regulation. There is just a little problem with that argument, which is that in the laws of most countries, you have provisions that are known as general anti-abuse laws, or the economic substance doctrine, that says that any transaction or any structure that's created with the sole goal of avoiding taxes is illegal. And I think everybody understands that when a company like Google creates a holding company in Bermuda to shift hundreds of billions in revenue, the sole goal is to avoid taxes because there is no substance in Bermuda. There is nothing of substance. Let me just conclude by saying that to make progress in regulating corporate power, we will need to fix this tax evasion. Thank you very much.
Thank you for that. A round of applause from the audience. So let me jump straight to Jan, because Jan, you have been one of the very much first to emphasize the concerns around concentration and against the growth in margins. And the big issues that arise from there, inequality and problems in the way in which society is ultimately governed. So you have been at the forefront. Give us a sense of where you are now. You are also thinking about the implications, for example, of AI around this. Take it away.
Thank you, Christina, and thank you for putting on also macro as one of the issues that are the consequences of this concentration debate. And this is a conference also looking forward, what's going to happen in the future. And I think AI is one of the issues that are going to really be determining what's going to happen to these macroeconomic consequences as well. Let me first point out what is the biggest, in terms of market capitalization, tech firm in Europe. It's a firm called ASML. It's a semiconductor machine or materials lithography producers. So they make the machines. They're an absolute monopolist. They sell to NVIDIA. They sell to the Taiwan Semiconductor Manufacturing Company. And so what they illustrate is that on the one hand, yes, Europe does have tech companies. And in fact, it's a very important tech company. Its market cap is 330 billion euros. That's 1/3 of a trillion. Recall that it took until 2018 before the first company in the world had a $1 trillion market cap. That was Apple. So they're growing very fast. They're actually, as I said, an absolute monopolist. And as Thomas already hinted at, really the problem with AI is that the concentration, the market power comes really from this supply chain. The supply chain that is, from a macroeconomic point of view, from a global economy point of view, is becoming much longer. And because it's much longer, it's much easier for companies to have either bottlenecks or kind of narrow hourglass points where they can basically exploit their position. So yes, Europe also has big tech, but also therefore we have big monopoly. And so this is going to be important, I think, for the macroeconomic consequences. By the way, the universities are out of this race. You know, it used to be that universities were developing stuff. In fact, for that particular company, ASML, which is a company that's only an hour drive from here in Veldhoven, the Netherlands, just across the border from here. As they say in Belgium, from any point in Belgium, you drive an hour and you're either in a different country or speak a different language. And so, you know, they're literally in the countryside. They used a lot of the technology that was developed at universities, but universities are just not capable of producing what they're producing. Their machines are worth 200 million euros. They ship them in 3 parts in 3 different large cargo planes. So there's just a kind of a demand on the production process that no small business can deliver. Now, the universities are out of it. The government is out of it. The government is no player anymore. Even the US military is now no longer a player in AI anymore. So we can see that that concentration is going to have a huge implication for the future in terms of the type of concentration that we'll see. We probably won't see it necessarily in our consumer products, but we'll see it indirectly through cloud computing. Because why is this company so important? Because cloud computing, AI, is imposing such a big demand on for these precision chips and this technology. And so you don't only need the chips, you need the machines that produce it, and that's what this company is doing. Now, what does this have to do with inequality? Well, one of the consequences that we've seen over the last 4 decades is that this rise in concentration, this rise in market power, gave rise also to an enormous increase in inequality in the labor market. What we call the college premium went from a premium of 50%, whether you had done college compared to you didn't do college, went to 100%. Now, there's one potential silver line that people are pointing out that AI might have is that it might reduce this college premium. Why? Because what AI is going to do is it's going to take away a lot of these cognitive jobs, as we call them, even non-routine cognitive jobs that were basically benefiting from the digitization, but now AI is going to do some of these jobs, and this is going to potentially lead to a decrease in inequality. But there is one issue that we cannot forget, and that is, first, if there is so much of an increase as a result of AI, further increase in concentration, this is going to lead to inequality in one direct sense, that is between basically profits are going to go up and wages on the one hand, so levels of profits and wages. But there's a second thing that we see, which is that corporate profitability, markups or profits either way, has a big impact on superstar earnings. So one of the things that we see is that CEOs, for example, get paid for creating market power. CEOs get paid in a very competitive CEO market because they create value to the firm. Now the question is, do you create value to the firm because you become more productive, or do you create value to the firm, profits to the firm, because you generate more market power to your firm? And when we analyze what happens to all the CEOs starting in 94, when we have data on it, to today, what we see is that a substantial share of CEO compensation, around 40% on average, comes from the fact that these CEOs create market power for their firms. The firm doesn't care. The shareholder says, I want profits. I don't care how you create them for me. Now, the important thing is not just the 45%. The important thing is that in the distribution of CEOs, you have CEOs of small biotechs, you have CEOs of large tech or non-tech companies. We see that the proportion that the CEO's compensation that is driven from creating market power is actually very small for these small biotech companies. And it's around 80% for these larger firms, in particular Tim Cook, who in 2022 had a salary of 80 million. About 80% of his compensation came from the fact that he creates market power. I mean, he has a duopoly, for example, in the App Store with Google Play. And that creates an enormous amount of profits for Apple. It doesn't necessarily create value to the economy, it just creates profit to the firm. Of course, we all woke up this morning finding out that there's one CEO of a company called Tesla who makes 50 billion in 1 year. And he immediately threw a tantrum because the judge threw it out. So he threw a tantrum saying that the judicial system in Delaware is not worth it. But in any event, I think that this is the type of CEO who's probably an outlier in any sense. So what we see is that basically the role of AI, even if it may reduce inequality for college graduates, it's going to create many more of these superstar effects, which are going to lead to much higher compensation for those superstars. And that's not just CEOs. Think about coders. Think about, well, some of the lawyers here. Think about any person who's performing a job that's for a company that creates value to the company through higher profits from that market power. And that superstar effect has been on the rise for the last 4 decades, and it looks like what AI is going to do is going to boost this even further. Now, Gabriel already pointed out, it's not just about income, it's also about wealth, the stock of what people hold. We see that there's an enormous inequality and has been rising, especially, and that's Gabriel's work with his co-authors, in the very top of the distribution. That's related to the fact that there's some very few people who do extremely well. And so if you look at the returns to investment in the top 1% of the wealth distribution, that's orders of magnitude bigger than the returns on wealth for anyone else in the distribution. So we see also a huge increase in inequality there. And I think for future, with new technologies such as AI and cloud computing, this is doesn't look like this is going to stop. So let me just stop by asking, why do we care? I think we care because there's something that's, first of all, inefficient. You know, it's not just the consumer surplus, there's also the entire welfare. And in economics, we talk about the kind of the first theorem of welfare economics. We say if markets work, we have an efficient outcome. There's also a second theorem of welfare economics, which is about the redistribution, making sure that, maybe as a planner, you care about someone earning, 10 zeros more than someone else. Now, one thing that competition policy does is competition policy tackles these two things at the same time. So you basically kill two birds in one stone, because competition policy restores efficiency. You get back to what we call the first theorem of welfare economics. But also you create redistribution, because all these kind of distortions that we've seen are also distributional distortions. You're going to see a reduction in these superstar compensations that are coming from market power, that are not coming from just being productive. It's coming from the fact that you create market power for your employer. And basically, I think this shows that there's a very important role for competition policy to basically restore not only efficiency, but also restore kind of a redistribution that we've seen that had disappeared over the last decades.
It's great. Let me go to Florian, last speaker on this panel. Two questions for you, or rather, you've of course been a key contributor to the discussion with the work you've done on killer acquisition. He is with colleagues the father of this idea, and of course you've done also work on common ownership. Areas which are important and yet do not get the same kind of recognition from the classic industrial economic organization hierarchy that effectively feeds into antitrust. Why are the interesting economists? I deliberately invited these economists to this panel because they're not IO economists, have you noticed? These are not antitrust economists, they're different types. And the people with something interesting to say today come from outside the antitrust world. So, Florian, take it away.
Well, thank you very much, Christina. It's lovely to be back here. I am actually an IO economist. I'm somewhat of an outlier on this wonderful panel. But IO economists have a bad reputation. Tommaso already told you about that reputation. I'll add to that reputation in a little bit. IO is dogmatic. It's dogmatic about the types of questions it studies. It's dogmatic about the type of methods that are admissible for studying those questions. And it's also quite exclusionary in terms of the people that are allowed to study certain types of questions. And I'll illustrate that in three ways. The first one is on the questions. There's an immense focus on short-run prices and markups, and pretty much at the exclusion of other questions. The reason is that it's the proverbial lamppost that illuminates the area. The methods that we have in IO are good for searching around that lamppost, and that's exactly where we're looking. And that means that we are not really studying much more interesting questions on innovation, privacy, variety, quality, and so on, all of which have been absolutely integral questions in what I'd like to call an antitrust revolution of the last decade or so. Number two, it's very, very specific about the types of methods. Okay? So as a good Catholic, I'm very much reminded almost of Bible scholars or Talmud scholars, and the recitation goes like, the gospel of Berry, Levinson, and Pecos says we must use the holy ritual of demand estimation and use the holy purification ritual of Haussmann instruments. Okay? And there's no other way of doing things, and if you do things in another way, we will completely ignore your work. Okay? Now, I'll speak more a little bit about that type of playbook. Okay, it is very much one of rejection, and then sort of a little bit later on, it's like, oh, I guess that research was kind of right. It just didn't use the type of stuff that we are entirely accustomed to from the beginning. And then 3, it's exclusionary when it comes to the types of individuals who are allowed to study, because the types of people who study it, they all look like me. They're white male, and Christina, you and I were at an antitrust conference at Northwestern a few years ago, where literally the only non-white male speaker was Susan Athey. And I think that leads also to a situation where you exclude many interesting opinions and a diversity of opinions, and that means you're going to miss some very, very interesting questions. Now, antitrust is very, very much exciting again. There's a reason why you are all here. But within antitrust economics, that charge is coming very much outside of the industrial organization antitrust one. There are people like Jan who have written super influential papers on markups. Jan is not an antitrust economist to begin with. There are people who have written stuff on labor market power. It's Ioana Marinescu and so on that have gone on to the DOJ and really transformed also the way we think about market power in these labor settings. Again, outside of industrial organization. You've seen it also on the innovation side, you've seen it also on the common ownership side, and I'll speak to that in a little bit. The new guidelines that the DOJ and the FTC have released very much acknowledge that. You look at those guidelines, there are 11 guidelines, and they're very much in tune with some of the new research, and some of that research is not coming directly out of industrial organization. One of them is specifically about common ownership, and I think that is one of those really big questions. It's coming from outside of OIO. It came originally from corporate finance, some of the work that Jose Azar and Isabel Tecu and Martin Schmalz have done. And it recognizes this really, really, really big trend of increasing concentration of ownership for equities, not just in the US, but pretty much around the world. I give these statistics that when people hear them for the first time, they're entirely surprised by them. I have to update those statistics every single time I say them because the percentages are only going up. BlackRock and Vanguard, for example, are among the top 5 shareholders for 80% of US publicly listed companies. So that means you're going to own, as some of these large asset management companies, multiple firms that are direct competitors with each other. Now, if you are the largest owner of several direct competitors, you might then start thinking about, well, should I really encourage competition here? Do I really have the same incentive that an undiversified, non-common owner would have? And the answer is no. That is a very simple theoretical argument. It's been around for a long, long time. Back in the early 1980s, Julio Rothenberg already made that argument, and now we have evidence that this does indeed reduce competition, that it does reduce how intensely these firms compete with each other. We have it from airlines, we have it from consumer goods, we have it from pharmaceuticals, we have it from a range of different types of outcomes. So it's not just prices, and it's not just markups, but it's also about innovation, and it's also about entry. Now, it's true that it's not in all of these markets that common ownership really leads to a lessening of competition. It's not in all of those markets that it leads to higher prices. Ready-to-eat breakfast cereal, the favorite industry of industrial organization economists. In that industry, it turns out common ownership does not have really strongly anti-competitive effects. But, the response to that common ownership literature, how much of an anti-competitive effect this has had, was very, very similar to, I'd say, the response that you saw to the work that Isabella has done, which is initially one of entirely rejection, saying, no, this cannot possibly happen, this cannot possibly be true. Oh, if you do it with our methods, then it's not true. And then suddenly an acceptance of saying, like, oh, you've published something in a top journal. Oh, now we believe you. Okay? And so that's, I think, very, very similarly along those lines that it has gone on this. Sometimes also the rejection comes because you see caricatures of the theory happening. You know, in the case of common ownership, the caricature was, oh, but it's not that Larry Fink from BlackRock phones up these airlines and tells them how to raise prices on particular airline routes. Of course, we don't believe that that's what happens, but that's a totally misstatement of what the mechanism really is. The mechanism is much, much more one, a passive one, an indirect one. I, as a common owner, I don't have as much of an incentive to push for strong price competition or innovation the way that an undiversified owner that's just invested in one company would press those forms for. I mean, you see that also in the CEO compensation. If I go back to Jan's point, companies that have a lot of common ownership, they don't tend to reward their CEOs quite as much for intense performance. They essentially discourage CEOs from competing, and the way you do this is just don't make the compensation quite so performance sensitive. And so the truth is much more nuanced. It's not that capitalist conspiracy, that common ownership has gone up and now BlackRock, Fidelity, and Vanguard and State Street are telling companies not to compete. It's just much more indirect and much more passive. Okay? And it also has really big implications. If you look at the welfare implications, some of the work that I've done with Bruno Pellegrino highlights that the deadweight loss of common ownership, so the lack of competition between companies, can lead to as much of a deadweight loss of 2 to 5%. Okay? That's under a variety of different corporate governance assumptions, but it's big. Now, where's that deadweight loss coming from? It's coming from a redistribution of consumer surplus that's now accruing to higher profits. Okay? And I think, if anything, it understates even the impact, because we're treating consumers kind of all the same. But who are the consumers that are at the same time also investors, i.e. the ones like me and you and Jan, okay, who are also hold ETFs and hold mutual funds? Well, we're all benefiting from higher profits because we're also invested in the equity market. But if you look at how concentrated actually equity holdings are, 92% of equity holdings are held in the US by the 10% richest shareholders, and so 10% richest consumers. So it has huge income inequality implications as well. So I'll end it here. It's that antitrust is not super well equipped to answer these kinds of questions. There's very much a step. You can see it with the merger guidelines, the new ones that acknowledge common ownership particularly, and also that look specifically at interlocking directorates.
That's wonderful. We are running late, and I know I'm detaining you from coffee, so we will release you. But before I give the last minute to Doha for a few reactions to this, and I'm sorry, we won't have time to just go back to each of the speakers. For the audience, this is a collection of amazing economists. 4 of them are pioneers and superstars, and they are not in the traditional antitrust space, but they are people who are saying things that are salient. They're important to our society. They're pointing to questions that we need to actually address. When we do antitrust cases, we do a vertical arithmetic, for crying out loud. And I'm saying this as someone who has been in that field for many years, and I cannot stand it any longer. As Doha says, vertical mergers are about power. They're not about doing some sort of stupid vertical arithmetic that makes us no wiser. There, I said it. Take it away for the final moment.
Thank you for this discussion. I agree with all of that, Christina. Look, I'm going to try really hard to summarize all of the discussion and project into the future why this is important, because the goal of your conference, as I understand, is to think about the future. Some of the issues that underlie the really incredible scholarship of this panel bring people, at least in the United States, to antitrust in the first instance. We had massive demand-side market failures in the United States. There was the financial crisis. There was the market failure that was induced by the pandemic. And I think that I've often said in public engagements that when people are worried about the future, they look to antitrust for answers. And so wage stagnation, concerns about growing income inequality, concerns about how firms amassed all of their power in the first instance, again, has caused people to look to antitrust. And so for all of us, that kind of discomfort with the dogma of I.O. has caused us to go back to the law. I am not an economist. The law is what I know best. And thinking about the goals of antitrust, I think, has helped us really ground our work. But it is nonetheless comforting, it is reaffirming that there are scholars, such as the folks on this panel, who are largely echoing that we are thinking about power in the right ways. And I think we often overlook the fact that neoliberal economics and the sort of generic idea that markets are going to have an answer for all of our problems really assumes away, or would rather not deal with, the problem of power. And so the consequence of that is that we can't then think that wages, strictly speaking, are a measure of the marginal productivity of workers, or that prices are a direct output of some demand curve, right? We have to think about power in the first instance. And so when we're thinking about frontier technologies like AI, we have to think about the accrual of market power, recognizing that the whole supply chain is already concentrated. And so if and I fear this, right, and it is worth checking in on whether my fears are realized. If this might be the high watermark of competition today, we need to be thinking about whether market power can really be said to grow opportunities in the future, or if what companies are actually doing is preserving terminal value for themselves for the future. And if that is the case, I think many industries will continue to suffer, and we have an obligation as antitrust law enforcers to make sure that we are policing economic liberty, because ultimately we are responsive to our citizens in the United States.
A great note on which to end. I think we can all deserve coffees at this point. Big round of applause to these speakers. We are running late, so just grab a coffee and come back in, because we don't have time. Thank you.